Market Prospects, delivering timely information and education to prairie farmers for over 25 years. Market Prospects is brought to you by the University of Saskatchewan's Department of Bioresource Policy, Business and Economics, and these sponsors. Log on to marketprospects.usask.ca to view past programs and for information on upcoming programs.
In the Market Prospects interview this week, we zero in on the canola situation and outlook. Joining us from Winnipeg is Dr. Derek Brewin, Associate Professor of Agribusiness and Agricultural Economics at the University of Manitoba. Welcome, Dr. Brewin.
Thank you for having me.
Well, let's start with your assessment of the canola markets and what we can expect for movement, prices, and ending stocks in the current crop year.
The current situation is kind of dismal. We've got burdensome stocks worldwide in the oilseed market. Last year we had a record oilseed crop worldwide, and some of that happened here in the prairies. So that's decreased our export prices in Vancouver. And because we had this big crop of canola, we also had big crops in wheat, barley, and the rest of our crops. We've got burdensome stocks on the entire grain and oilseed sector in Canada. That's put pressure on our supply chain, and that's really kind of widened the margin between the export price and the farmer's price. The only good news in the supply system, the S&Ds, is really the soybean market in the United States. They didn't get as much area seeded because of the good returns to corn last spring. So they're actually in a tight situation, and that's pretty good for meal and oil prices.
So what do you see as the key factors currently affecting price and basis in canola markets, and the main factors to watch in the upcoming crop year?
Still, you know, the biggest mover in price last year was the worldwide S&D, and that's still something to watch, which you can track in the USDA outlook reports. But kind of new to the market is this wedge between the export price and the farmer price, and that's something that's happened as the supply chains got plugged up. Last year, the margin between export prices and Winnipeg prices was about $120 a ton. Last year was around $50, and it's been $50 for most of the last few years. Right now, it's at $120 a ton. So that's a factor that we really want to keep our eye on. The entire market's concerned about storing the canola right now. We've got University of Manitoba researchers saying that canola stored in poor conditions past spring thaw really drops in value. So everybody's concerned about losing that value. And the crushing margins, the crushing forward contracts are not giving them a big incentive to store. If you look at the forward contracts in December, they're not much better than they are right now. And the summer forward contracts are even worse. So the price incentive to store is not very strong either.
So what's your canola price and acreage forecast for the coming growing season on the prairies? And do you think farmers should be locking in prices and basis for the upcoming crop year?
Well, I kind of follow the Ag Canada S&Ds for canola, and Ag Canada is suggesting a slight increase in area for canola, and I would agree to that if we're staying at that $450 price, which is within the range that they're forecasting, a $450 a ton return. The farmers in Western Canada are making some money over their variable costs at $450 a ton. If the price falls below that, towards $400 a ton, then I think we'll probably see a decrease in area seeded, because at $400 a ton, farmers aren't making very much money, and canola is an expensive thing to put in the ground, so I think we might see the area decrease if the prices fall too low at seeding time. But I don't expect that. We're at $450 now, and we've got a possibility of increasing the on-farm price by fixing that supply chain problem. You know, the 120, we could get back to 50 and add $70 to the farm price just by fixing our supply chain. So that's the potential for upward movement. At these low prices, I wouldn't want to advise anybody to lock in, but some farmers are being forced to do that because of concerns about storage in the new year.
Please explain prairie canola crushing margins and why they are so much higher than U.S. soybean crushing margins.
Okay, the canola crush margin is calculated and published by the Intercontinental Exchange here in Winnipeg. They look at Chicago soybean oil and meal values. They convert them into Canadian prices, and then look at the revenue that a ton of canola could generate in oil and meal, compare that to the current cost of a ton of canola trading on their exchange. And they put that number out, and last year at this time it was $20 a ton Right now it's $200 a ton, which indicates very profitable crushing margins in the crushing sector in Canada right now. In the U.S., that's a different situation, mostly because the soybean prices are higher relative to canola prices, and that's because of that tight soybean situation in the United States. So that's one of the main reasons that they're tighter. But even when we had tight margins and the canola and soybean prices were closer last year, they had tighter margins, so there seems to be a structural difference between soybean crushing margins and canola crushing margins as well.
So what's the rate of canola crush this year compared to last year on the prairies, and what issues do crushers face moving oil and meal to market?
Yeah, the crushing pace, given the fact that we've got these very profitable crushing margins, you'd expect the crushers to be running at near full capacity, but that hasn't been the case. The crushing capacity so far has been less than 80%. It's part of the supply chain problems. According to the crushers, they're not able to bring the cars in. They were getting some of their supplies by rail, so they're not bringing in some of the crop, the canola. And also they've got problems getting the meal and oil out because they usually use rail system for that. The farmers can help on that problem by trucking the canola into the crushers, and that certainly should be part of every canola grower's marketing options, is to look for their options to truck the canola to the crushing plants. And they could look at trucking to export position. If they can get to the U.S. market or Thunder Bay and capture more of that $120 margin that they're losing right now versus export position.
Well, thanks again, Dr. Brewin, for taking some time to come on Farmgate. Great information.
You're welcome. Thanks for having me.
Okay, stay with us. Farmgate returns after a short break.